What if I told you somebody else is making money from your hard-earned savings? Let's say you deposit $10,000 into a bank. You probably think your money is just sitting there, safe, untouched, waiting for you. You earn interest, your money grows, and whenever you need it, you can withdraw it. But here's the interesting part. That's not the whole story. Behind the scenes, your money is part of a much bigger financial system. The bank doesn't simply store your deposit. Your deposit becomes part of the bank's funding, and the bank uses that funding to support activities that generate income. Here's a simple example. Imagine you deposit $10,000. Let's say, purely for illustration, the bank pays you 3% interest per year. That's about $300 a year. Sounds pretty good, right? But now look at the other side. Banks use their funding, along with other sources of financing, to provide loans to businesses, home buyers, and other customers. Imagine the bank earns an average of 8% on a loan. On $10,000, that would be around $800 of interest income over 1 year. So you receive about $300. The bank receives about $800 from the loan. There's a $500 difference. This difference is part of what we call the interest spread, and it's one of the fundamental ways banks generate income. But wait, that $500 is not the bank's profit, not even close, because running a bank is expensive. Banks have employees, branches, technology, mobile banking systems, cybersecurity, fraud prevention, and regulatory costs. And then there's something even more important. Risk. What happens if the person who borrowed the money doesn't pay it back? The bank could lose money. That's why banks carefully evaluate borrowers before approving loans. They look at income, cash flow, credit history, collateral, and most importantly, the ability to repay. But credit risk isn't the only challenge. There's also liquidity. You can ask for your money back, maybe tomorrow, maybe next week. So a bank cannot simply lock all of its funding into long-term loans. It needs to maintain enough liquidity to meet withdrawals and other payment obligations. And then there's capital. Banks are required to maintain capital and follow regulatory requirements designed to help them absorb losses and protect the stability of the financial system. So when you look at the bigger picture, your $10,000 isn't simply sitting in a vault with your name on it. Your deposit becomes part of the bank's overall balance sheet. The bank combines deposits with other funding sources. It makes loans. It invests. It earns interest and other income. It pays interest to depositors. It pays employees. It pays technology and operating costs. It absorbs losses when borrowers fail to repay. And it manages liquidity and risk. Whatever remains after all of those costs and losses can contribute to the bank's profit. So let's go back to that $10,000. You earn interest from your savings. At the same time, the bank is using its overall funding and balance sheet to generate income. But there's something you don't see when you open your banking app. Risk. The bank takes credit risk, liquidity risk, market risk, operational risk, and regulatory risk. That's why the difference between what a bank earns and what it pays isn't simply free money. The bank has to manage an entire financial system to earn that return. So here's the real lesson. When you deposit money in a bank, you're not just storing cash. You're becoming part of a much larger financial system. Your deposits help provide funding. That funding supports lending and other financial activities. The bank earns income. It pays its costs. It manages its risks. And if everything is managed successfully, the remaining amount becomes profit. So the next time you look at your bank balance, remember this. You see your savings. The bank sees funding. And behind that simple number on your screen is an entire business model designed to make money work. That is how banks make money from your money.